Good morning. Thank you guys for making it out. I know it's a little early. My name is Cassy Wagner. I'm a senior reporter at Blockworks, and I'm very excited to be talking institutional DeFi with these gentlemen. We can start with a quick intro for everyone. Did you want to start, Alex?
Sure. So my name is Elkrief. I run Fractal. We're an infrastructure provider building infrastructures to settle margin and clear assets across one another on chain. So you can think about it as, let's say you have $10 million of staked AVAX. You want to sell some calls against it, but today you can't really use your staked AVAX as collateral for those options. So by putting all these things inside a Fractal sub-account, you can do so. And you can do so with the help of a margin loan where we're increasing transparency for the lender because they can see what's in your sub-account in real time.
Phil?
Awesome. Phil Wirtjes here. I'm with Enclave Markets. We're a Ava Labs incubated company, a trading venue. We've launched two products, Enclave Cross, which is an automated OTC desk built within a secure enclave, which just means a confidential trading venue. And then actually, as of Wednesday, just launched our spot exchange. And so looking forward to growing that one.
And I'm Jacob George, so I run Field Labs, and we are building the Truefin protocol, which the idea of that is similar to some of the stuff that, it overlaps a little bit with some of the stuff that Alex was talking about. It's basically options, infrastructure, and DeFi, and the idea is that it's institutional focused.
All right, let's get started. So in terms of how institutions are thinking about DeFi right now, what are like the main concerns, use cases, solutions that they're looking at? Jacob, did you want to start?
Yeah, sure. So I think that's a really important question. So at the moment, first of all, like what's an institution? So by an institution, I'm kind of thinking, a mixture of traditional financial institutions. So all of the big asset managers, all of the big hedge funds, all of those kind of guys, and in terms of like using DeFi infrastructure, I think really I've had a lot of conversations over the last couple of days, and the biggest thing that you really need is for them to not notice they're using DeFi infrastructure, right? Like, so really, what's the promise of DeFi and how do we get them there? Well, the promise is if you can go to somebody's COO and say, hey, look, I'm going to cut your back office cost by 60% and I'm going to replace 1,000 people with 50 devs, that's promising. If you then say, oh yeah, by the way, it's on a blockchain, they're like, not so sure. So the question is, how do you get them there? And I think a lot of us have kind of thought about this, and a lot of the key things are things like KYC and KYB, like making sure that institutions can basically participate in a way that's kind of safe and doesn't potentially ruin other parts of their business in a regulatory sense, and basically getting them to understand the promise of blockchain and the kind of and essentially the efficiencies that it can give them. That's the main thing.
Phil, do you feel like you have to ease institutions into it?
I think that's a great representation of how to treat institutions and how they're entering the space. Jacob mentioned the user experience, and for as far as blockchain has come and the crypto ecosystem has come, still a pretty clunky ecosystem or like user experience to onboard, to switch from one platform to another, to touch one asset versus another, and I think that hurdle needs to be overcome to really bring institutions into DeFi. Alex probably has a perspective on that. And then I think the other thing is compliance. Counterparty risk, KYC. Institutions need to know who they're dealing with, and they need to know that they're good actors. So until we can do that in sort of a repeatable, sort of widespread way, I think we're going to see sort of a blocker to more institutions coming in, but that's part of what we're trying to solve at Enclave, and I know others up here on the stage are trying to solve as well.
Well, I obviously agree with all the above. I'm also part of a protocol that KYCs their users, which is rare, but less and less rare in this space. So yeah, of course, KYC needs to be solved. I think in the tooling side of things, custody hasn't been quite solved fully, and the intersection between cold storage assets and the fact that if you are trading on a blockchain, invariably your assets are going to sit on a chain, and what does that look like? A few years back, we were still walking around with Ledger wallets in our backpacks. So like now that's been solved. That is a good thing. But then also just to your point about institutions, I think the first institutions that are going to adopt this are speculators. And even for speculators, so hedge funds, the infrastructure is still very, very broken. Something as simple as OEMS and trading systems and reporting tools. So in my previous role, I was, at a hedge fund running a DeFi book. The number of hours that I spent trying to explain to our auditor and our fund admin what transaction is what when you are taking token A, depositing into Uniswap, receiving some token that's called LPABC345, and then staking that in another pool, and then using that as collateral on Aave to borrow something else. It's gibberish. And so just the basic infrastructure for everybody to do their jobs and for fraud not to proliferate is something that we still have to fix.
When you're speaking with hedge funds, what are they looking toward DeFi for? Are they interested in tokenized assets? Are they interested in settlements? What kind of use cases and solutions are they really looking for? Alex, did you want to start?
Sure. So I think, well, again, the first niche is the crypto hedge fund. They are used to interfacing with on-chain assets. Interestingly, so products, started with spot. Now we have derivatives. I'm talking my book, but enabling better collateral management. One request that we've had a lot for support in our sub-accounts is tokenized US Treasuries. If you do have to keep stale assets in your sub-account to send margin back and forth, there's no valid reason that it couldn't be a yield-bearing asset so that the two counterparties in the tri-party repo agreement are still can split the 4% or whatever the T-bill rate is. And then over time, we'll expand to more and more products. I think it starts to look, the DeFi world is very used to that notion of yield, and so whether it be with options or with, I know Securitize and others are working on putting credit funds on chain, starting with liquid assets and getting them more and more complicated to be supported by the same infrastructure.
Maybe real quick on that too, I think capital efficiency is a big thing that we hear at Enclave. Right now, most trades are fully funded unless you go to a specific protocol that offers some credit. And institutions are used to trading with credit and trading with more sophisticated products. And spot's really interesting. It's something that we do at Enclave, but if you think about traditional finance, a lot of the volume flows through derivative products, to Alex's point. So until we can bring that sophistication on-chain as well, I think we're going to sort of still be waiting for that next wave to come on. And I think that's really going to be the gateway that ushers in institutions into DeFi.
Yeah, I totally agree. And I think it's important to actually keep in mind, what the point of all of this is. So, why do institutions want to look at DeFi in any way whatsoever, right? The reason why you want to do it is because you potentially get better distribution, you potentially get more efficiency in terms of trading, and you have access to more interesting products. Right now, almost none of that is true of DeFi, right? And so our challenge is actually to build all of that stuff, right? So collateral is an enormous point. Everything being fully funded is a massive problem in DeFi. And making it less than fully funded is a non-trivial task, right? So that's another thing that we're trying to do in the option space, and I know a lot of people are trying to do in the perp space. So I think, why do institutions want to get into DeFi in the first place? Well, it's because there's money there in some way, right? And the question is, how do they access that? And that money could be in terms of efficiency savings, in terms of operational stuff, or it could be just price discrepancies versus centralized venues. Almost none of crypto is decentralized, right? And what the papers call crypto, right? So all of the stuff that was going down, most of it was not decentralized, right? Mm-hmm. And the entire point of crypto is to decentralize it. So I think the next wave of things to come through will be kind of true decentralization in some sense. And what we need to try and make sure of is that we actually end up with high quality product at the end of all of that, rather than this kind of clunky XYZ coin stuff that Alex was talking about.
It all comes back to money. Phil, do you feel similarly about the infrastructure issue? What's the current landscape when it comes to infrastructure? What are we missing?
100% agree. I think Alex and Jacob both made great points. I think one thing that Jacob said is, how do the papers perceive DeFi or crypto? And that's, you hear a lot of FTX, you hear a lot of Terra Luna because it's great headlines. But what that sort of does is trust a single point of failure in the process. And the point of DeFi, and I think what's attractive to institutions, is they don't need to trust one single actor. especially in this sort of murky regulatory environment. And so what on-chain finance brings is transparency and monitoring. And I know you talked about that quite a bit, Alex, but it truly is sort of like the piece in the institutional process that I think is super, super critical to keep an eye on, to track, to monitor, and again, we'll bring sort of those institutions into DeFi.
Alex, what are you watching on an infrastructure standpoint?
I think to the point of decentralization, let's start by solving the simple problems first. Decentralization is kind of like the end goal that we all aspire for, and where the system is fully automated and we can all disappear and the software will keep running and it's censorship resistant, etc. The first features we have to solve for, or at least that we're trying to solve for, are the features of the blockchain, even if it's centralized. So these are transparency, instant settlements, live risk monitoring, verifiability by third parties. And if we can just solve that, lower cost, disintermediation of the 10 or so intermediary layers that happen when a trade gets put on in traditional finance. So if we can just solve these things first, we enable a massive cost reduction in the cost of operating finance. And then that's what, then we can think about decentralization and making sure that the systems become more autonomous. But I would focus on those first.
Yeah, I totally agree. I think actually DeFi itself is a bit of a contradiction in terms, right? Because on the one hand, you want to make things decentralized so that they don't have a single point of failure. On the other hand, if you want liquidity, you need some kind of centralized execution venue, right? That's kind of what a market is. It's a bunch of people turning up in the same place, all wanting to trade, right? And so, the challenge of DeFi is to do both of those things at the same time. And I agree, right now, the thing that most people want, and I'm talking about most people in the world, not most people in crypto, the thing that most people want is something that's easy to use, that's efficient, and gives them good liquidity. And actually, they don't really care what's under the hood, right? Because, if what's under the hood is bad, then hopefully the FDIC steps in. So it's so our challenge is basically to kind of almost by stealth decentralize a bunch of financial infrastructure by providing stuff that the UI and the UX is slicker than traditional finance.
Yeah, I can't emphasize that last point enough about sort of what this next wave looks like, but it is the user experience and removing, as you disintermediate all of these steps, you can't reintroduce them in clunky user experience to click on this wallet, this token, that token. And so sort of smoothing that out and making a slick UI, UX, I think is critical.
Jacob, you brought up liquidity. What's the current liquidity landscape right now?
Centralized, more or less. So I mean, with some notable exceptions, right? So, I mean, I think, when I first started looking at DeFi in general, the idea of AMMs and Uniswap in particular were just mind-blowing, right? I mean, this is, what does Uniswap actually do? It takes a bunch of capital from a bunch of people that have it, that need yield in some way, and it uses it to make markets, right? That's what banks since the 15th century have been doing, right? That's, when Monte dei Paschi and all of these guys were founded in the Italian city-states, what did? They took a bunch of capital in, and they made markets with it. And Uniswap does that in a single equation, which is a mind-blowing feat, right? So, and especially when things start to depeg, like when we had the USDC scare, the decentralized venues were the only ones that were really still working. Everything else gets suspended. And you see this in traditional finance too. When the Swiss floor broke in 2015, all electronic trading ceased, and the market became a bunch of people shouting on trading floors, right? So, the idea of decentralized finance is to basically have something that functions even when everything's going wrong. That said, when stuff isn't going wrong, generally centralized finance beats it. So, when you put everything on a centralized venue and you have, all access in the same place, generally liquidity will be better. And so, really, when you ask, what's the state of liquidity, it depends where you mean. Is it when everything is as usual? Because then it's probably, still on centralized venues. If you're asking where is it when stuff is really blowing up, it's in decentralized finance.
Do you agree, Phil?
Totally agree. I think one thing, and this sort of speaks to the sophistication as well. So like Uniswap in the AMM model, you put in a big block trade, you might chew through a bunch of the liquidity pool, you eat up a bunch of slippage, but you're already seeing sort of the next wave of sophistication even in that. So Trader Joe has these liquidity bins where you can essentially replicate a limit order on a DEX, which is sort of a next wave of innovation. And again, it's bringing these tools that institutions are more familiar with using onto the chain and sort of operating in a DeFi way.
Alex, what are you watching in the liquidity space?
I generally agree. We have a problem in this industry whereby we're all very tribal and everybody's launching their own chains, and liquidity has a tendency to aggregate in one place. And so we need to see some winners emerge, and it'll probably be driven by capital efficiency and user experience. And then on the point about what works well and when, and it was actually very, very heartening to see. Still today, so decentralized finance works for big markets. Uniswap is the best market for the ETH USDC swaps. It beats decentralized finance at scale. And you're right, when everything was going down in flames during the USDC debacle, you could trust that you could swap on 1inch and Paraswap and all those providers. So that was very interesting to see, and it's been interesting to see that in every crisis scenario, DeFi, which frankly I would like to rename on-chain finance because we're all getting problems with this DeFi nomenclature, is really, really resilient.
You all mentioned KYC. What are some of the different challenges associated with collecting that data? Alex, did you want to start?
Ooh, that's a tough question. I don't think it's actually that difficult. It's mostly a question of the right integration, and frankly, some of that business will be manual. There are some interesting solutions. I mean, the Avalanche KYC at Subnet is a very appealing example in that it abstracts the load of KYC to whoever is running the KYC, but doing it just once and then being able to interface in this walled garden. We're seeing other examples with, again, Securitize is powering a lot of DeFi protocol KYCs, which means that if we have to onboard with a institution that is already onboarded in their network, we don't have to run KYC. Other than that, it's just something we have to do. It's boring, it's annoying, and it doesn't have to be revolutionary. We just have to get it done.
Yeah, just quick on that. I couldn't agree more. From our perspective, it's how do you take the friction out of the process? It is a boring process, but it is something that needs to be done. I think there's also an issue of fragmentation. So to like on-chain KYC, to Alex's point, it's super, super interesting for the future. Preventing an institution from onboarding once here and then replicating the process there and then doing it a third time over here. You can do it once, and that token that basically verifies you as a good actor travels with you across whatever blockchain you're operating on. So that's a really interesting part of the KYC puzzle that we're keeping our eye on. But to sort of go back to your question of like what's difficult from an institutional perspective, I think it's actually a must-have. From the retail perspective, I think that's where the difficulties come in because it's not a fun process. So again, going back to my original point, like taking the friction out of the process is sort of how we think about it at Enclave and are thinking about it on a daily basis.
Yeah, like I think that's exactly right. Like it's a must-have, right? In the sense that, what are the difficulties in KYC? Well, it's that it exists, right? Like it's kind of it's a pain. Like nobody wants to do it, but everybody has to do it, right? If you're going to be an institution and you're interacting with anyone, you need to know that they've been through some kind of process. Usually that process is bilateral in some kind of way in traditional finance. And the power of the stuff that you guys are talking about is really exactly that you go through that tedious, painful, horrible process once. And then you get some kind of token that says that you've been through that process. And it may be ZK, it may be whatever, right? But somebody has to go through that process at some point. And actually the most powerful thing is getting effectively some kind of passport that says that you've been through that process and you can interact with other people that have also been through that process, right? Because one of the big things that you really can't do if you're an institution, you can't, I mean, if you're a massive bank or you're a big asset manager, there's no way you're risking your banking license to go punting in some DeFi pool, right? So the only way that you do that is, one, if the spreads are enormous, and so there's a vast amount of money and you're just being completely amoral about the whole situation. That isn't the case currently in DeFi. And the other way that you do that is if all of the actors have gone through some kind of KYC or KYB process. That's the other way that you do it. And the subnet is a really good example of that, where you effectively, shift the load to a different place. But either way, if you want to get large parts of traditional financial infrastructure operating on a blockchain, there needs to be some layer of KYC or KYB, whether you like it or not.
Just in terms of regulation, Jacob, you mentioned, so being based in the UK, what are some of the biggest regulatory uncertainties? You said when we were talking off stage, there's just a lot, there's no lines. So how do you operate within that environment?
You don't, is the basic answer. So, as you know, the Truth-In protocol is built offshore. I really don't like that. I wish it wasn't. But at the moment, where essentially you need to operate in a jurisdiction where there is regulation of some kind.
Does that exist right now?
It does to some extent, yes. So
where?
So BVI, Cayman, a bunch of these places have actually put in regulatory guidelines for exactly what you can and cannot do. There are really strict rules on reverse solicitation and what countries you need to geo-block and all of this kind of stuff. And so you have to tread very carefully around those rules. But at least there's some level of regulatory clarity. I think in the UK, they're kind of getting there. There are discussions that are happening, like the Treasury has been putting out calls for feedback and things like that. And my hope is that the government, the sounds from the government are that they're pro-crypto, but they've got quite a lot on their plate right now. So who knows, when that actually, comes to fruition. But I think actually, stuff like MiCA is really important. Whether you like it or not, the fact that it exists is meaningful. And the fact that people have actually kind of done the work. I've been to a few kind of working sessions in London where people have been talking about this kind of stuff. And, they were kind of Chatham House rules, but, some of the people there were from, some of the big kind of, European central banks and all these kind of guys. And they're kind of saying, look, we don't necessarily know what we're going to do with DeFi, but it's on the radar. We will do something, and we'll kind of make more specific regulation as and when we can. I think that is really meaningful, because as a builder, you're sitting there on some funding, you have some kind of runway, and the last thing you want is, at some point, for a regulator to turn around and say, actually, you guys can't do that here.
Are institutions more hesitant, and this is for everyone, to get involved when there is regulatory uncertainty? Phil and Alex, you can speak from the US perspective.
Oh yes, absolutely. I think the regulatory environment has gotten a lot more stringent in the US. The area was very gray for a number of years, and nobody is playing games anymore, and nobody is transacting in the US. Everybody's trying to avoid serving US customers. We don't serve US customers. We're offshore, which is frankly a shame. We would love to see more forward-looking regulatory guidance, and also having a little bit of reassurance that whatever the rule becomes, it won't be too backwards looking. The biggest risk right now that we feel in the US is that whatever you did 3 years ago is going to put you in jail. And that is driving a lot of innovation out of the country, which is frankly a shame, because the center of finance remains New York. And it would be great for all of those institutions not to have to move dozens of staff members away for them to make decisions outside of the country to be able to operate.
Yeah, we hear it all the time in our conversations with institutions, and I think your point was a great one. You don't want to mess around and lose a banking charter or something like that. Look, institutions are okay with yes, they're okay with no, but at least there's certainty. What's not okay is why don't you act first and we'll tell you if it was okay later, to your point about a look back. Yeah, exactly. And right now, that's unfortunately sort of the current state of the regulatory environment, and it makes it really hard to operate.
Yeah, the regulation by enforcement is really what we're seeing right now with a lot of these cases. I mean, how does that impact your business? How do you think about that?
3 times is probably the right answer. I mean, it's just like the leading, I would say, strategy or like conversation that you have for any business decision is start with the regulatory impact that it could have and make sure that you think it through from every angle. And I think that's good in many ways, but one thing it does slow down is sort of pace of innovation and speed. Yeah, I mean, it's an ongoing conversation for every decision that we make at Enclave.
I think for innovation as well, you were saying this yesterday when we were meeting, is the lack of guidance is so expensive for us in terms of lawyer fees. I mean, you were referring blood tax, yeah. And every time you have to pick up the phone, you have to ask for advice. Nobody knows the guidance, and every time you pick up the phone, it's thousands of dollars. And we're all operating on, MVPs trying to find product market fit and trying to survive to the next fundraise or to the closest point of revenue. And the amount of money that gets wasted on the best uncertain possible advice we can get from lawyers is astounding.
Yeah, I totally agree with that. My eyes water every time I see the bill, and it's kind of. But I know that it's a necessary evil, right? Because we're sitting in this world, my background is traditional finance, and I saw kind of the waves of regulation come through traditional finance. And, practices that had been completely standard 20 years ago were retrospectively outlawed, and a bunch of people went to prison, right? And the last thing we want is for the same things to happen here. So I think, one of the things that's been great about this conference and great about, one of the very few things that's been great about the last year is actually the people that are left are really the adults in the room that have been thinking about this stuff from day one. Like when we were talking about KYC and when we were talking about AML compliance a year ago, we were like the weird dude at the edge of the party, right? And suddenly you have kind of Luna and Celsius and 3AC and FTX, and suddenly everyone cares about that stuff. Whether it actually fixes the issues or not is a different matter, but suddenly it's part of the conversation in a way that it definitely wasn't a year ago.
It's a good time to be a compliance lawyer. We only have a couple minutes left. I wanted to kind of ask each of you what you're most excited about in this space, what you're looking toward in the next, we'll say, 6 months to a year. Jacob, did you want to start?
Yeah, sure. I think the stuff that you guys are doing in Enclave, like a lot of these kind of DeFi, CeFi hybrids, which kind of recognize that, the biggest thing that you're trying to do, especially in these higher dimensional derivatives, I guess, is to try and have some kind of way of matching liquidity and some way of then settling liquidity. And one of those things can be on-chain and the other thing can be off-chain. And as long as they're securely linked together, that's meaningful. I think that's enormous. If you can kind of get that right, then you can really get those operational efficiency savings through into traditional finance.
Couldn't agree more. I would add, more sophisticated tooling, and Alex is working on that. And I think more sophisticated tools or instruments for institutions to trade and sort of unlock liquidity that otherwise doesn't exist today. So I think those two things are what we're keeping our eye on at Enclave, and certainly are hearing from institutions in every conversation that we have.
Yeah, I'd say we've complained a lot on this panel, but all things considered, if we zoom out for a second, there's actually, so for a year and a half during the peak of the bull market, most of the things we were seeing were just forks of the same code base deployed on another chain, and innovation has actually returned. What you both are doing is super interesting, and we'd love to have it clear on Fractal eventually, and the interoperability there is very interesting. The other component is seeing the credit markets unlock again, and so we're doing a lot of work to bring transparency to that space, but eventually we need better capital efficiency across the space, full collateralization, pre-funding, all of that doesn't work for real institutions, so making progress towards that would be a giant step.
Definitely. Well, it's an exciting time for on-chain finance. Thank you all so much.
Thank you.
Thank you.